Folks, I have a extra special announcement to make at the opening of this episode. Looks like Mr. Dan Bird has agreed to come and do a 3-hour session for the One Rinse at a Time community. It will be on July 16th from 8 to 11 a.m. This is brand new information just discovered in the last 5 minutes, so I do not even have an Eventbrite for it. I will create one, put it at the bottom of this link, but more importantly, put it at the bottom of the link for our daily financial news, which I will announce tomorrow morning. So again, July 16th, 8 to 11, you will have the opportunity to have Dan talk about risk management. We will
That's
talk about
the specific time.
Yeah, Pacific, yeah, basics of charts, and then we will allocate an hour to your stocks and your questions. So you asked for this. He graciously heard your requests, and we now have it scheduled July 16th, 8 to 11 Pacific. More data to come, but I'm excited, Dan.
We
Thank you
don't
so
even
much.
have an agenda yet.
No, it's brand new, man, brand new. But we know
But
we are doing it.
it's basically going to be technical analysis 101, how to get started, how to set up your first charts, some additional indicators that I use, and then some of the platforms that I use in my trading.
Yep.
And I'll explain how they work and how you could use them. And then when we open it up, we'll open it up to questions, and I'll actually bring charts up for any symbol that anybody wants to see, and I'll, give my opinion. Doesn't mean it's going to go the way I think it will go, but it'll just be basically I'll explain how I use the charts to evaluate a position.
Yeah, this is something.
Oh, and the other thing that is really going to be, I think, really exciting is I am going to show my risk calculator as well, which is what I use to do position sizing to make sure I'm positioned correctly. I'm not buying too many shares, and make sure that my risk is as low as possible. So I have a calculator that calculates all of that for me. It's very quick and easy to use, but I'll show that too.
Yeah, again, for me, this is where we started. You can go back and look at Dan's playlist. Dan, I think it's just Dan Stocks. This is where we all started, the risk calculator. And I'm glad we're going to start there. You're going to do basic chart analysis 101 and then answer questions. It'll be a jam-packed 3 hours. You and I have done stuff like this for 2 decades. I have a sneaky suspicion it might run a little long, but I know we will give everything we can. So let's get into today, though. What's going on in the market? Let's talk about M2 money supply. And we'll get into it. So what's going on in the market? It broke 4,300, I think.
It broke it
significantly,
significantly, and with vigor.
Yeah. All right.
And I'll show you what I mean here.
Chart.
Yeah, let me share this. First, if anybody wants to join my newsletter, just send me an email to breakpointtrading@gmail.com, and I'll add you to it. I don't sell the emails or anything like that. This is really just sharing my own research that I do every weekend. I'll talk about quadruple witching here in a second, but this is what happened on Friday. Friday was quadruple. Actually, it's triple witching now because one of these they actually don't do anymore. Single stock futures hasn't traded since 2020.
Got it.
So it's really triple witching now. That occurred on Friday, and I'll talk about what that meant and where I think things might be headed as a result of that. So that's the newsletter. Let me show the long-term market. So you see this big one right over to the far right. Let me make this a little bit bigger.
Yep, I see it.
That was last week. So this is a weekly chart.
That's
what I mean by it broke the resistance definitively. So 4,300 was right here.
Went through it like a hot knife through butter.
Right, just above this shaded area. And I've been saying for a couple of months that the shaded area was going to be a big area to get through. There would be a lot of congestion here. There'll be a lot of back and forth. The bulls and bears would be fighting against each other in this area, which is basically what happened. But last week we definitely broke through it.
So let me ask you a question. Now, again, we've been doing this a long time together. Does your natural inclination is that we have to break lower and test the floor before going higher, or do you think this parabolic move was so sudden it just keeps going?
Well, I think the reason it went up last week was because of CPI and the Fed, which is what we had talked about the week before, and kind of what we both kind of expected to happen.
Yeah, I mean we nailed both. Yeah, we got the 4, and we got a pause.
4% for CPI, and we got a pause from the Fed. even though they're talking about, yeah, we're still going to do two more.
That's such a
But
joke. That's theater.
well, we'll see. I mean, August, I think inflation will look like it's going back up again.
It could, yeah, not July though, but maybe.
Not July. July will actually be bigger than this one. July
Down,
could
bigger down.
July could send it down to 3%,
Even 2 9s possible mathematically now.
even with a two handle. Yeah. But August may start to, creep back up again, and the Fed might
Mhm.
use that as an excuse to
Maybe.
do another quarter point. We'll see.
Okay.
But so what do I think? So if you look at this move, 1, 2, 3, 4, 5, that's 5 weeks higher, each one higher than the previous week.
hmm
That is not sustainable
Yeah, not
in the
normal.
market. It's not normal. It's nice. It's great.
Yeah.
It's very healthy, but that's not the way markets typically move. Now, could it keep going higher? Absolutely, it could.
Right.
It could do anything.
Right.
But typically, what normally will happen is this will retrace some. And on that topic, let me show you this. This was in my newsletter this week as well.
Oh yeah, I
So this
love
is
this. This is so
yeah, this
telling.
is yeah, this is called a Keltner channel. So if you look at these different colored channels here, the darkest one in the middle, that's the Keltner channels are determined by the ATR, the average true range. So the average range that a stock or an index will move in one day. This is a daily chart. So based on this period, what will it typically move in one day? So that's the dark one in the center. The next darkest one moving out, that's 2 times the average true range. So you take what it would typically move in a day and you multiply it by 2, and that's what that outer range is. Uh-oh, are you still there?
Yeah, I'm here. I can hear you.
We just had a surge. So my connection could go out if we get another one. The third one, the lighter one out here, is 3 times. That's 3x. So if you'll notice here, it rarely gets to 3x. And when it does, it doesn't stay there very long. You can see it got there in February and came back down, got there briefly in December, came back down. And then this big, huge rally in August, it got up into that as well. Now, what happened last week for 2 days, we were in the 4x range.
Yeah, we were above that. That was really telling in your newsletter. Great stuff.
Not even the 3x, we're in the 4x range. The
Yeah.
only time that happened before was last August. And actually, let me do a 1 year 0 and probably see this better. All right, so here's August. You can see there for that one day, it got into the 4x range. And then you see what happened afterwards.
Yeah.
All right. So I don't expect it to stay up there. I don't expect it to continue going higher. What I expect is a reversion to the mean.
And that would take us roughly to 4,300 if
a little below 43, but yeah, 43 is now the floor.
Right.
That was resistance. It's now support.
Nice. It's like I'm starting to understand this French thing.
Right.
Thank you.
And we're going to talk about that in the Technical Analysis 101 in the session that we do in July.
Yep.
That's in fact, that's where you start with technical analysis, support and resistance. That's the number one thing besides price and volume. Okay. All right. So that is very telling. I think we need to come back down to 4,300, test that as support now. We should come down and touch it and then bounce off of it if we're still in a healthy bullish market.
Okay.
Right. But that would be very good if that happened. If that came down to 4,300 and then started back up again.
Okay.
That's what I'm expecting. Let's now look at, this is the triple witching days.
Look at that volume.
I put this in the newsletter as well. Yeah. See the volume days there? So that's what happens on triple witching. Triple witching is the 3 things, the options and futures that all expire on the last Friday of the quarter. They all expire at the same time. And it causes huge volatility. So you can see the huge volume on each of those 3 days.
Yep.
All right. Now, what typically happens is what Tom Bowley calls opposite George week. For those Seinfeld fans, you'll understand what opposite George means. I actually put a clip in that newsletter. on opposite George that gives you a little 15-second Seinfeld episode for what happens when George decides that everything he's been doing has been wrong. And if it's all been wrong, then maybe what he should do is the complete opposite of what he normally would do. And all of a sudden, his whole life turns around and improves. So opposite George, this kind of shows it here. So let's go back and look at the one in December. We had for a month, we had an upward trend from October, the October low, until roughly around the beginning of December. We had an upward, actually even towards the end of December, we had an upward trend. All right. Mm-hmm. And then this red circle here is the week just before triple witching. So about 3 or 4 days before. So this is what I mean by opposite. The trend was up previously. Just before triple witching, it reversed and went down big in that case. All right. Now, if we look at the last one that happened, and this one is in March, that time the trend was down. All right. This big red arrow.
Yep.
And just a couple of days before triple witching, it reversed and went up instead. That's what I mean by opposite.
Okay.
All right. And then now this one that just happened on Friday, the trend went up and it really didn't reverse until Friday. And that's mostly because of the CPI and the Fed announcement. Mostly what kept this going. I think if those two things had not happened last week, then the market would have reversed earlier in the week.
Got it.
All right. But it reversed on Friday. And I think that's the beginning of the effects of triple witching.
Okay.
Now, why does this happen? So what happens in each of these cases, but we'll look at the one back in October, it started going up and lots of people were buying. In fact, everyone was buying calls. When we got to triple witching, if you looked at the balance between calls and puts, it was heavily weighted towards the calls. There were very few people buying puts, very few people thinking that the market was going down. Everybody thought it was going up again. So there are lots of calls. Well, on options expiration, the market makers, they have to make a market on the other side. So if everyone's buying here, the market makers have to be selling in order to have a balanced market. The best thing for them, if everyone is buying calls, the best thing for them is to push the market down before options expiration so that as many of these calls as possible will expire worthless, meaning they don't have to pay out on them. Now, you could call this manipulation. In fact, it really is manipulation.
Yeah.
But if you understand how the market works, you can play this to your favor.
Yeah.
Right.
Very cool.
So that's what happened there. Same thing happened here. There were tons of puts in this case because the market was trending down. So it was to the market maker's advantage to push the market up and have these puts expire worthless. So they wouldn't have to pay out all that premium. Okay. Now that often continues into the following week. And I think it's going to, especially this week, that's going to be true. And the reason that happens is because as these options expire, all of these people that bought calls way back here, they were way in the money. So if they bought them back here at 3,600, and now when we get to, options expiration, the market's at 4,100, 500 points. They're like, well, great. I'm not gonna close my option. I'm just gonna convert it to stock. I'm going to exercise my option. Because I have it now at 3,600. So I'm going to exercise my option. I'm now going to own this at 3,600. And now I'm going to have the actual stock. Okay. So the same thing happens with the market makers. They'll look at that and on Monday, they'll say, oh, everybody is converting their options into stock, which means they're buying the actual shares. So if they're buying, the market makers have to sell. So they have to cover the other side. They have to balance the market. So this selling that happens, the opposite George week, the selling that happens often goes into the first part of the next week. Okay. And you can see it happen there. It continued going up in this case. And I think next week, this will continue going down for the same reason.
All right. So again, our wild ass guess is we're going to see a retest of the 4,300. We're hoping it holds and we rebuild from there versus tearing through it. So it'll be a fun week to watch.
We actually would want to see a retest of 4,300.
Awesome.
That would be a healthy thing to do. Now the 21-day moving average, which is reversion to the mean, is at 4280 roughly.
Okay. Roughly.
And
All right.
it's rising. So, somewhere in that neighborhood, 43, it could go a little below 43. It's not an exact number, but
Yeah, of course. Of course.
somewhere in the 4300 area, it would be very healthy for the market to go down there and then start to go back up. If
Okay.
that happens, be ready with your watch lists,
Mhm.
and be ready to jump into stocks, because it'll probably be a good place to buy them. One other thing, this was not in the newsletter, but I've showed this before. This is the put call ratio. So this
Mhm.
is the ratio of puts versus calls. And this is a 253-day moving average, which is the number of trading days there are in a year.
Mm.
And if you look at 2021, when the market was just zooming to the top, the put call ratio, meaning everyone was buying calls, nobody was buying puts,
Oh, look at that.
right? When it was lower than it ever had been. This goes back to 2004,
Wow.
right? Lower than it ever had been, meaning nobody was selling. Nobody
Mhm.
was buying puts. Everyone was buying calls. And then it leveled off here at the end of 21. This is one of the reasons why Tom Bowley and some of the things that I said when we first started doing this
Mhm.
was that 2022 was probably going to be a big down year for the market.
Yep.
This is one of the reasons. This is the post-COVID, all buyers when this goes down. What we needed to happen here at the end of 21, we needed for this to reset. We needed for it to get back to normal. And this is a theme for this next piece that we're going to talk about. So for that to get back to normal, the put call ratio had to climb back up.
Mhm.
So now you can see what's happened since 22. We had a big down year in 22. Look how steep that curve was. So now everyone's buying puts in 2022. Nobody's buying calls. Everyone wants to be short until we get to 23 and the market started taking off. Now, because this is such a long moving average, it takes a while for this to roll over. But once it does, you can see where it rolled over, where these arrows are. And then the green line moving down. You can see once that does roll over, you can see what the market does.
Mhm.
This is right after COVID, it took off. Now this one rolled over right here, which is about a month ago.
Okay.
All right. And you can see the market is just starting to really take off. Now, this is the rate of change down here. So you can see the rate of change actually happened right at the beginning of 23, when the market really started taking off and all the growth stocks and technology and all of those started really taking off.
Yep.
So we could be just on the very beginning of this huge rally.
Fun. Very cool.
All right. So now let's talk about money supply.
Yeah, the M2 money supply, it's often used by the fear mongers and doomers because, again, money supply is down 5%, which it hasn't done since the Great Depression. But you correctly point out that, you know what, we've done something kind of crazy the last 2 years. So,
Yeah. So the point I was trying to make is that don't listen to the news media. Don't listen to CNBC or Kramer. I mean, I'm not saying don't listen to them. It's fine if you do. You can once in a while get some interesting stuff. But if you do listen to that stuff, remember the context. Remember to keep in mind the context of what's going on in the market. So the articles that I read about money supply, they all said money supply has dropped by 5%. The M2 has dropped by 5%. That has not happened since the Great Depression. We are in for a huge correction. The market's going to sell off big time. And
well,
I can't argue with
let's
that.
be clear. Not only the market, they're using this M2 money supply going negative 5% to say the economy is going into a depression.
That's right. The economy is going into a depression because last time that happened, we had a depression.
Exactly.
All right. Whenever I read those articles, I'm always looking for the paragraph that says, however, we have not had a 100-year pandemic either.
Right.
All right. So what does that mean? So I put some proof points. It's the first time I actually put this together like this. I put some proof points in the newsletter. So this is the Baker Hughes oil rig count. So here's the pandemic. All the oil rigs were shut down. Took about a month. Actually took 5 months to shut them all the way to the bottom, but most of them were shut down within the first month or two. All right.
Mhm.
And then when the pandemic reached its trough, and actually when people started going back out and traveling and buying stuff again, you can't you can't bring up these oil rigs at the same rate as you can stop them. All right. So it
Exactly.
takes time to bring this back. So clearly, if you just know a little bit about economics, you know that supply and demand says if you have no supply and all of a sudden huge demand, you're going to have a big price spike. That's
Yep.
just natural.
Yep.
Now, they can't bring them back in the same rate that they closed them down. So we had oil and gas going through the roof, right?
Mhm.
First Fed rate hike was here. I maintain it should have been down here.
Ah. Mhm.
The Fed should have seen this. They should have understood economics 101. They should have
Well, they,
seen was
yeah, this is such a supply demand curve. It just
right,
happens to be the commodity is oil. You're absolutely right. They should have seen this and known what was going to happen.
right. So now let me make my second point. So this commodity is the container index. These are containers that carry all of the merchandise, typically from China,
This
that
was
ends
amazing.
up getting
I
sold here.
I remember ranting about this when it was 11,000. I remember that exactly.
11,000, right? It only took 18 months to get to 11,000. So here's when the pandemic shut down right here. By the way, that's the same date I used over here, 313.
Mhm.
So I kept the dates the same. 313 right here. The cost of a container was $1,300.
Yep.
All right. The economy shut down. All of that merchandise that was sitting on containers sat out in the ocean for
Mhm.
months.
Months.
But the cost to do that, the cost to store that was astronomical. It went up more than almost 10 times, nine
Yep.
times. So it went from 1,300 to $11,000,
Crazy.
right? 23 months to the second peak, almost $10,000. That's the second peak, 23 months to get to there. There's the first Fed rate hike right
Yeah.
there.
It's amazing.
They should have been hiking at least at the peak up here, but probably somewhere as this was starting to go up like this.
Agreed.
They should have been hiking. So in both of these cases, it shows how far behind the curve they are. Now, the reason that I show these in relation to M2 is this is highlighting what I'm talking about. The pandemic is a 100-year pandemic. You have to put all of these things in context with a 100-year pandemic. So when they're talking about M2 dropping by 5%, and that hasn't happened since the Great Depression, here's M2. Here's my chart for M2.
Mhm.
There's the 5% right there.
Yep.
They're right. It has dropped 5%.
Mhm.
And they're right. That hasn't happened since the Great Depression.
Correct.
But guess what also has not happened since the Great Depression?
That vertical line.
Yeah, a 100-year pandemic
Oh, look at
has
that
not
vertical
happened
line.
since the Great Depression either.
Yeesh.
So put these things in context. If this just got back to normal, so I put a line right here starting from the last debt ceiling crisis in
Yeah.
2011 and just drew a line which is basically 45 degrees
Yep.
on what the M2 supply had typically grown by
Yep.
right there. And if
Yeah.
you extend that normal growth, you would have ended up right here. But instead, we had a 100-year pandemic. Everybody put their money in the bank and didn't buy anything with it,
Yeah. They
right?
stopped spending, got checks. It was an amazing
Right.
time. The
They got they
savings
got
rate
they got checks for
exploded.
doing nothing. They got checks for doing nothing,
Yeah.
and
And
they
then they
weren't.
stopped paying mortgages. They stopped paying rent. They stopped
And they
paying
stopped
student
shopping.
loans.
They stopped going
Yeah.
out. They stopped going to stores. They stopped going to restaurants. They stopped doing everything. So all of this money ended up
Boom.
sitting in the bank.
Yep.
That grows M2 money supply, right?
Exactly.
So yeah, it's down 5%, but guess what? It needs to come down another 15%
Yeah.
just to get to normal.
Yeah. I agree with you. Yeah. The M2 money supply has to come down. In fact, I would argue one of the things that Jerome Powell is trying to do is to get M2 down. Now he won't say that
Right.
because of all the noise that would come from that, but he's trying to wring out liquidity, and part of that's addressing M2's big bubble that you see here.
Yeah, exactly. And this is all because of that 100-year pandemic, all these things that I just showed.
Mhm.
So when you read these negative articles like this, and friends and people send me these all the time,
Yeah, me too.
and they send them to me like, hey, I've got this inside information.
Yeah, like it's a super secret. You
I
missed
have
it.
the super secret information that the economy is going to crash because of the M2. And look, it hadn't done it since the Great Depression.
Yeah.
And then I counter by sending them something like this and say, of course it's going to come down. It has to
It's
come down.
supposed to. Yeah, exactly.
It's supposed to come down. We need to normalize. We are
Yeah.
in the process of normalizing everything.
Hmm.
The price for containers is now back to normal. The
Yeah.
oil rigs are actually not quite back to normal yet, but they're pretty close to it. So M2 is the same thing. We're just trying to normalize after this huge imbalance that the pandemic caused.
Yeah.
So
Totally agree.
so my point is, when you hear these things, when you hear these negative articles, when you get links in your email, say, click on this link and I'll explain how you can avoid the coming crash.
Yeah.
Take it all with a grain of salt, put it in context with where we are right now.
Yep.
Don't click on it. Do your research, understand what's actually happening under the covers.
Yep.
The only reason they're putting those kind of at CNBC and media and things you get in your email, the only reason they're doing that is so that you'll click on their sites or that you'll stick around for the commercials.
You got it.
That's why they do those things. Just put it
Folks,
in context and do some research.
folks, we have an amazing event coming up on July 16th, 8 to 11 a.m. You're going to get the one and only Dan Bird doing 3 hours. We're going to talk about risk management, risk calculator. We're going to talk about basic 101 charting, and of course, open an hour for your Q&A. If you want to be at that event, I will make sure there's an Eventbrite link down below. We will also be announcing it tomorrow on the Daily Financial News. Dan, thank you very much for doing that. Close with your newsletter, please.
Yep. If you're interested, there's no charge for the newsletter. Just send me an email to breakpointtrading@gmail.com and I'll add you to the list.
Thank you, buddy. I appreciate you. Happy Father's Day.
Happy Father's Day. Hope you have a great one.
Thank you, buddy.